Hello.
Hi, everybody. How you doing?
How's it going?
Good.
Good.
Tyrone?
Good.
Hey, what's up?
Tyrone and I were in accounting 2 together a couple months back. Block 4 or 5, I think.
Accounting, and then something after that too. I think we had two class. I can't remember the other one though.
Yeah. Accounting 1 and accounting 2.
You and
Yeah.
Tyrone? Thomas?
Yes.
You and Tyrone had a class together?
We had accounting 1 and accounting 2 together. The last
Yeah.
couple of
Hey, me too. Me too, guys.
Hi.
Who's me too? Which one is that?
Rihanna. Rihanna.
Rihanna. Oh, okay.
Yeah.
Hi, Rihanna. We can't see you.
Am I supposed to show my face?
You know, you don't have to. I mean, I kind of like it if students do, just because, you know, kind of helps me build rapport if I can see people, you know.
That's true. Let me go to my settings. Is it okay to do it?
But if it's a bad hair day or something, hey.
It's a terrible hair day today. I haven't done anything.
You know, I haven't done much.
Would you recommend going on your computer, or can you do it on your phone too?
I'm on my
Yeah, you could do either one. I do my, you know, I'd probably recommend on the computer just because you'll have a
hey,
bigger
Kelly.
screen.
We were in accounting with Kelly too.
Hey,
Yeah.
Kelly was in accounting
Yep.
with you too. So,
Yeah.
so okay, so this is, and
Same
did you
with
guys
Tracy.
have Steve Gilmore?
For accounting 2, yes.
Yeah, okay. Well, this will be a much
And
better
we all were in
experience.
the same
No.
class.
I'm kidding. Steve's a good friend of mine. I like to rib him a little.
All right.
Yeah, people in the waiting room. We'll wait till, let's see, on the class list, I got 1, 2, 3, 4, 5, 6, 7, 8, 9 people. So, and right now, it looks like we got 7 here. So we'll give others another minute or two to join in. Okay, Langdon, were you in accounting too with these guys too then?
I don't believe so.
Kelly,
okay.
we can't hear you.
You can't hear me?
Oh, yeah, we can.
Okay, yeah. I heard him, yeah.
Sorry.
No, that's, so let's see, 1, 2, 3, 4, 7. Yeah, we'll wait till we get everybody so I can, you know, I mean, I'll wait a couple more minutes, and then if somebody else ends up coming in, that's fine. I used to just say people could enter the meeting before me instead of doing, you know, the waiting room thing. And, but what happens is, because I record these and I record them, and I'll put them on a link, and you know, you'll have access to it if you want to, you know, if there's a part that maybe we went a little fast or whatever, and you want to go back over or something like that, you can do it later. But what I found is, if I don't do the waiting room, if I just say enable participants to join even before I join the meeting, sometimes people will turn it on like 20 minutes ahead of time or whatever. As soon as one person enters, it starts recording, and then pretty soon it'll tell me that, you know, so we'll have 30 minutes recorded before I even start the meeting sometimes. So I thought, maybe it's better, since we're recording the meetings, to have the waiting room instead. So yeah, like I said, wait, maybe 1 more minute, see if we're getting anybody else. One person is waiting, Laura Walker. Admit her. Okay, so then I think we only have 1 more then. All right, Laura, you with us yet? Not seeing her.
I see her.
You see her? Okay. Oh, there's Laura. Hey, Laura.
Yeah, sorry. Was having some
Oh,
computer
no problem,
issues.
No problem. Okay. So now I think we're just missing one person. So let me figure out who it is. In fact, looks like the first name on my list. I believe it's Ishmael. Do you guys know Ishmael by chance from accounting or anything? No? Okay. Or Ismail. Might be Ismail. I don't know if it's Ishmael or Ismail. Or, yeah, Ishmael or Ismail, one or the other. Okay. Nobody knows him. All right. Somebody already shared something on the chat. Can you all hear me or no? Kelly? Yeah, we can hear you. Can hear you just fine.
I did this plenty of times for my kids, but I've never done this myself on my computer, so this is the first.
Oh, is that right? Okay. Well, until we went online here, I've never taught an online course before, and so until we went online, I had been on Zoom meetings or Microsoft Team meetings, just that I had been invited to, or WebExes, things like that. But I had never hosted one. So yeah, it was the first time for the first class was definitely a little clunky, and I kind of learned a few things after that. Yeah, it's definitely a different experience, that's for sure. But in some ways, it's kind of nice to be in the comfort of your own home, and be able to learn or teach or whatever. So, okay, well, Ishmael maybe will join us later. I'm not sure, but I'll go ahead and everybody else is here because Kelly's here, Tom's here, Michelle Minert is here, Langdon is here, Rihanna is here, and wait, where'd Rihanna go? Did we lose her? Looks like we lost. Oh, one person's waiting. Okay, I see that. Okay, Rihanna has to get back in. All right. Oh. Okay, Rihanna. Oh, gotcha. All right, great. Your hair looks great. You said you hadn't done anything.
I have not.
You have not, huh? No, looks great. Okay, well then, yeah, Ishmael is the only one we're missing. I don't know, based on the fact that you guys, had to be in the waiting room, maybe I'll do it differently next time. Like I say, the only bad thing about that is if I just say people can join right away automatically, even if I'm not on, the only issue with that is that, like I say, it'll start recording when the first person gets on, and I have had people, well, sometimes on like somebody was already logged in, and maybe they were just checking it out and stuff. Earlier today, I think I got somebody was already in the meeting. So yeah, that's why I thought, well, this time let's try it this. Okay. I'm going to go ahead and minimize that, and then I'm going to hit share screen here. All right, and I can still do this for a minute and maybe try to get all you guys in here if I can. Okay, so you guys should be pretty much seeing same screen I'm seeing. So, okay, well, the first order of business was just to check and see who all's here. And it looks like everybody is here except, again, Ishmael. So we'll have to notice if I get if you see something, say, oh, hey, Rob, somebody's waiting to be admitted. Think, oh, there it is right here. Another one is entered the waiting room, admit. And so this should be Ishmael. But I'm not seeing them yet. Ishmael, are you with us?
I see him.
You see him? You see Ishmael?
Yeah, I see him.
Okay.
Hello.
Oh, there he is. Okay. All right. Hey, Ishmael. Am I saying it right? Is it Ishmael?
Ishmael, you're right.
Okay. Okay. Good.
Yeah.
Good. Yeah, I wasn't sure if I was pronouncing it right or not. All right, good. Good to see you. Okay, great. Well, then, the first thing I wanted to do is go into Brightspace. I posted a bunch of stuff on there last night, so you may have noticed. Before that, pretty much all I had was just the syllabus on. So I do want to take just a really quick look at the syllabus, and then some of the other things posted on there, and then we'll jump right in. So okay, well there's our class list, but let me do this. Let me go to the content tab. Okay, and so what I'll do is I am going to go ahead, minimize this here for a bit, or maybe I'll just do the single row. There we go, single row. And take a quick look at the syllabus. Well, you know what? It's already on the Academic Center for Excellence. Why don't I talk about that first, okay? And then we'll go to the syllabus real quick. But there is a tutor for finance. His name's Kevin Castle. He's a student from Germany. I know he is, or at least was, on the soccer team. Nice guy. I've had him in class. Bright kid. So he is the finance tutor locally, or as part of ACE, the Academic Center for Excellence. This would be the way that if you go to this link, you'd be able to maybe get a message to him if you feel like you need tutoring. And then there's also 24/7, 7 days a week, 24 hours a day, the online tutoring. It's the document says Mount Mercy Quick Start Online Tutoring. It's not really the Mount Mercy tutor. It won't be Kevin on this one, but I'm not sure. I think it's something that there's a company called Helix, and I'm not sure if they're the ones that provide the tutors, but you can try going to that if you ever need online tutoring. And again, while I say all that, don't forget, I'm available to tutor too. So, it's not like, don't feel like you're bothering me if you email me with questions and whatnot. And again, sometimes if it's just a pretty simple question or one or two fairly simple questions, I'll just, if you email me, I'll just reply back with an email. Every now and then, I will do like a separate Zoom meeting for a student or a small group of students if they feel like, oh, gee, I'm really lost on a particular topic and whatnot. But obviously, I want to make sure they saw the regular meeting first, before I spend time Zooming with them on a separate. Okay, so that's two different options on a tutor on there. The online ones, again, I don't know who those people are, but supposedly you can get tutoring 24/7 there. And then Kevin Castle, who would be a very good tutor, who is a Mount Mercy student. And then, like I said, myself. All right, so let's take a quick look at the syllabus, and maybe what I'll do is move us over here so I can download this. And I'm assuming you guys have already looked at it. Okay, there we go. And just wanted to highlight a couple parts real quick. Yeah, I'm planning to Zoom every class as I've notified you guys about, you know, I'm setting them up for 2 hours a night. We may not always need 2 hours. It's always possible that we could need on a given night maybe more than 2 hours. Other nights we might only need 90 minutes or so. The stuff that you can get pretty directly from the book, I'm not going to spend a lot of time in Zoom meetings with if it's already something that I'm like, okay, this, you know, doesn't really need explanation and whatnot. But unfortunately, or fortunately, whichever the case may be, most of finance does need to be explained to people, even if they've read it in the book. And that's the reason that for this course, yeah, I figure, okay, a 2-hour Zoom meeting every night will probably work. Let's see, what is, so July 4th must be a Saturday, huh? Okay, so we will go ahead and meet on July 6th, etc. So every Monday, I think from now up through August 10th. You see the book there that we'll be using, and also this site here for homework. There is online homework that also comes with the book, but it's very expensive. I've used it in the past, and I actually wanted to get rid of it, and students told me, they said, oh, you know, I said to students, well, what do you think if I got rid of that? And I had students say, no, don't get rid of that for future classes, because they said that helped me so much, you know, to in your course. And I'm like, all right, I'll keep it. But number one, I really was not, I'm not to this day a fan of the publisher, you know, because I've tried to work with them to lower the price and on that, and they absolutely won't budge. So this homework, I think it's still only like $9.95. Somebody's registered for class, because he emailed me and said, is there going to be a class? Because I only have one person registered. I said, yeah, other people will be registered on this Accepi site. So here's the site you want to go to get into the Accepi homework. I'll go to that site here in just a minute. Before I do, you do also for this course, it would be really helpful to have a financial calculator. The one I recommend is the Texas Instruments Business Analyst 2 or 2 Plus, but I think all the new ones are called 2 Plus now as a financial calculator. It's the one I use. Some people have like a TI-85 or something, and you can use that too, but I'm not quite as, I don't own one of those, so I'm not as familiar with operating it. Also, students have asked me in the past, well, can I use Excel to do, like, you know, for instance, time value functions and whatnot? And I used to always say, well, no, because, you know, in class, I can't have you doing your computer on your computer during a test, because you know, I always had in-class tests, right? And I thought, well, you know, we can't have people like, you know, where they'd have the opportunity to email back and forth in the class during the test. But since the tests are online now, anyhow, I have told students, yes, it is okay then to use Excel instead of the financial calculator, but I'm basically going to teach how to do everything using the financial calculator. Now, I do have some Excel assignments that we cover later in the course, but anyhow, meanwhile, it's like I say, as I go through different things, I will talk about how you enter things in the financial calculator. So now let's look at that homework site real quick. And again, I'm pretty sure that it is still just, let's see, can I minimize this? Okay. And then try to hit, this is hard, Alice. Ah, darn it. Here's what I got to do. I got to move this to the bottom. Hide video panel. Okay, that's what I do. There. Now I can click on it, and all right, and then hit. Well, I clicked on something today that's doing this every time I want to. Gives me this site that I don't want to go to. Okay. So if you're a new user, here's the site. Yeah, it is still $9.95, which is awesome because the book I was using before, or the online homework I was using before that came, that was affiliated with the textbook, was like $140, something like that. So we're saving you about 130 bucks here with this homework. And then, you know, if you're, so this is what you do, you know, if you're brand new, an existing user, you can log in. I'll go ahead, log in, and just show you an example. So there's 3 different assignments here, and that corresponds to the material for each of the 3 exams. So assignment 1 is going to have some material from chapter 1. It's also going to have material from chapters 2, 3, 4, and 5. Okay. And in total, it'll be worth 20 points. Now, some of these will be multiple choice questions. Others will be problems. So just to give you a couple examples, first question here, this is actually just a multiple choice. I do give you 2 attempts on each of the multiple choice questions before getting it wrong. So a credit default swap is most like, well, we'll talk about credit default swaps, but basically I'll just tell you the answer on this one is it's most like an insurance contract. Now, if I hit that and I submit it, if it was incorrect, then it would tell me that was incorrect, and then I'd know, okay, I got one more chance to try to get it right. The problems, I give you 3 attempts to get it right on the problem. Okay, so then if I go to next problem, that's another multiple choice. Let's skip ahead to an actual problem. Here we go. Here's one where you'd have to actually do some calculations. They're asking, what was earnings before interest and taxes for the year? And, you know, so you'd go through the problem, figure that out, you know, on scratch paper, whatever, and then put your answer in there and submit. Now, if you get it wrong, you notice again, you get 3 attempts for the problems, 2 attempts for the multiple. So, you know, it's worked pretty slick since we've been using it. I do know on assignment 1, and I forget the problem, there is 1 or 2 questions I will end up, and I can't recall which ones they are off the top of my head right now, but there's 1 or 2 questions that I will go ahead and just give you credit for because for some reason they don't score it correctly. They don't actually give you a correct answer. And so anyhow, but I can't recall which questions those are off the top of my head. There's 1 or 2 of them like that on assignment 1, and there might be 1 or 2 like that on assignment 2 as well. I just started using it this past year, so it's still relatively new for us. Okay, well, back to the syllabus, and if I got it down here, yeah, there we go. Okay, so that was that Accepi homework. So if you just copy and paste that link into your browser, you can get to that site. And then, of course, we got course description, objectives, all kinds of policies, etc. And then grading. There's 3 tests worth 100 points each, and then the homework assignments on Accepi are worth 60 points total. So it's 20 points each on the homework. Accepi will score points. What I do is, so for instance, if Accepi says you got 90% of the points, I'll take 90% of the 20 points for that assignment and give you 18 points. Okay. if except he says you got 80%, I'd take 80% of the 20 points and give you 16 points on that assignment and so forth. There's also computer assignments worth a total of 50 points and 2 other assignments for 10 points each. So there's 430 points possible for the course. And then you can see what we're going to be covering each night, which tonight we're going to attempt to get through chapters 1 and 2. We may not make it all the way through, and that's okay if we don't, because chapter 1 is pretty meaty. I don't know if you guys have looked at chapter 1 already, but yeah, it's definitely fairly meaty. Okay, so any questions from anybody before I do anything else? Any questions from anybody? Get back on here. Oh, down there. Trying to see you guys again. How? What am I? Okay, let's see. More. There it is. Show video panel. There we go. Now I can see you guys. Let me see everybody here briefly just to see. Was there any questions about anything that we know? Okay. No? Ismail, did you have a question?
Yeah, I have a question about the book. So I get the book by mail, but I see the syllabus is talking about the online book. So we need that also, or
no? You can do either one. No, you can do either one. The physical book or the online book, they're identical. So either one is fine. Yep. Who am I missing? I'm not seeing everybody in here. If I go like that, okay. Yeah, I don't know. There, it gives me ways to move back and forth so I can see people that visit with you and stuff. Any other questions about the syllabus or the course in general before we look a little more at some of the other things that you have access to on Brightspace? And then we'll jump into chapter 1. So any other questions? By the way, if you're questioning what I'm drinking, well, let's just go with soda. No, one of the nice things about an evening course from home is I'm sitting at my bar, and so I figure, well, as long as I'm sitting at the bar, I may as well have a Busch Light with too. So
Hell
don't
yeah.
worry. Don't worry. I never go more than 2 on any class period. So yeah, and sometimes sometimes it's coffee, sometimes it's water, tea. Sometimes it's beer. Whatever I happen to be in the mood for. But I power washed my entire patio today. So and I have a huge patio. It was a lot of work, so I feel like I accomplished something. So I gotta have a beer for that kind of accomplishment, right?
Yeah.
Yeah.
So you're not gonna be annoyed if we use one too?
No, no. If you want to have a Busch latte, hey, be my guest, or whatever your preference. Mm-hmm. Yeah. So okay. Well, let me. If there's no other questions, let me do this again. Let's go back to like the single column, and I'll move it over here for now. And then we'll go back to the syllabus. All right, and then so here's the other things that you have on Brightspace under content now. And again, everything except the syllabus was pretty much added last night. So you saw the announcement on the Zoom meetings. I think each week I have copied the invite and sent it out each week because I think it changes every week. So I'll probably have to keep updating that. I got some time value handouts for when we hit chapter 9. This is an Excel assignment. This is also an Excel assignment. I got formula sheets, 1 for each of the 3 tests. I have worksheets. There's one of those to correspond with each of the 3 tests. I have a study guide for chapter 1 because again, chapter 1 is pretty meaty. And, you know, most of the chapters have like 1 or 2 kind of overarching themes that we cover. And so, you know, I don't feel like it's necessary for every chapter for me to have handouts or study guides, but chapter 1 definitely I felt like we should have. And then there's another Excel assignment, and then here's the directions for the VLOOKUP and pivot table assignments. That's 2 different assignments with 2 different data sets. 1 set of directions, one for the VLOOKUP, which uses 1 set of data up above, and then 1 for the pivot table, which uses another set of data. The homework assignments, I think we'll probably just go through those together on a Zoom meeting here in a week or 2. So you don't even have to do it as homework. And then I have, solutions to the worksheets. You know, I had 3 worksheets. I've got 4 solutions. Because one of the worksheets, some of the worksheets are just answers without details. Others, solutions show all the details to find the answer. So that's why I have more solutions than I have worksheets. Study topics list, I think that's for tests 2 and 3. I don't have one. Let me just double check that. Study guide for test 1 and review topics for the final. I'll have something for test 2 as well. Let's see. And then valuation handout on cost of capital with handouts, which those are, that's topic we get to in chapter 10. Loan amortization template, chapter 9. Other instructional handouts. Just to refresh my memory, I just want to remember exactly what all I have in there. Okay, so for right now, the only thing I really have is the chapter 1 study guide as far as these first 5 chapters, which is what we cover for test 1. So let's go right into that study guide. Unless anybody has questions about anything else I showed you for content there, different things we'll have going and things you have access to.
Sorry, when are the due dates?
I have to put the drop boxes on there. I haven't put those in yet because exactly, because I got to figure out the due dates, and I won't have anything due for at least a couple of weeks. Okay, so there won't be any due dates for anything for at least 2 weeks, and then I will get those drop boxes before we meet again next Monday, which was a great question, Kelly. And let me get that on my to-do list just in case I forget. Sometimes I think I've got everything done and I don't. Drop boxes. Okay.
Do you use the night of class as the night that homework is due or a different night during the week?
I'm sorry, Tom, what was that again?
Do you use the night of class as when the homework is going to be due or a different night during the week?
Usually the night of class, but like for instance, the homework, the Accepi homework, where you got to go to that Accepi site and do those. Those are due just like the day before the test dates. The tests are all going to be online. Those will be due the day before the test. Okay, and usually on the test days, I have those where you can start anytime after like 8 a.m. on a class day is the way I've been doing it, but we still meet for class that night. Now, that was an experiment that I tried, and I did have, for most people, it seemed to work out fine. They could schedule around it. I did have a couple people say, yeah, I work all day till 5 o'clock, and then we have our meetings. I'd rather not have the tests on that day. I'd rather have the tests, like the next morning or even on a weekend. I don't know. I can be flexible on that. So, you know, as far as test days, do you want to do it on a day that we meet together, or, you know, where you could start any time at 8 a.m. and I give you up until midnight to finish the test? They are timed. When I say you can start at 8 a.m. and finish by midnight, I do give you like 3 hours for the test, which should be more than enough time for anybody to finish a test, especially if you're, you know, if you're at least moderately prepared for the test. You shouldn't need more than 3 hours. You know, but from the time you start it, you could start it at 8 and you'd have until 11. You can start it at 9, 10, noon, 5 o'clock, whatever. But of course, we'll do our Zoom meeting 5:30 to 7:30. If you want to wait till after that, and at 7:30, you know, you'd have from 7:30 till 10:30, or, you know, 9 to midnight, whatever. That would be the latest. That's how I did it for the you know, last couple of courses, and the last night class I had. And like I say, I did have one student say, you know, I work all day. Can you do it on a weekend? I got my kids all the time, you know, et cetera. And I'm like, I'm fine with that. If you guys would rather have me give you a Saturday to take it instead, I guess I just want to hear from you guys. Do you have a preference on a day of the test? I mean, I won't give it to you before we've covered the material, put it that way. We'll have covered everything that's on the test before the test would be started. Would you prefer it? Let's see, there's a Monday class. I don't know. Saturday might not be the best option. We could always do Tuesday or Wednesday. You know, I could even give you a couple of days to choose from, you know, in terms of it. So you know, I just like to kind of know that everybody has an idea of when, you know, some window of when the test is taken. But I could make it like Wednesday or Thursday. You got either day, anytime from 8 in the morning till midnight, Wednesday or Thursday. I mean, I can do whatever. So you guys have a preference?
Having the couple day option sounds nice.
Okay.
Yeah.
It's
All right.
So
And then I think what I'll do, all right, I'm gonna make a note of that. So we'll do, yeah, a 2-day option on the test. And I think since, like, let's say, well, we'll just be covering the material on a Monday night that you'll be tested on, why don't I give you until Wednesday, or make those 2 days, Wednesday or Thursday, or I could make them Thursday and Friday. If I make them Thursday and Friday, the only thing is I may not get them graded by Monday. If, you know, if I have to grade on a weekend, you know, depends on what I have going that weekend, but it is summer. I do have some things going some weekends. So you know, if I gave you a Thursday and Friday, how about a Wednesday, Thursday? Does that work for everybody? And then that way I could promise you to have them graded by the next time we meet, that following Monday night, and then we could go over it in our Zoom meeting. Does that sound good to everybody? Okay.
That's good.
Now, let me say this. If for some reason it absolutely does not work for you, let me know. I have the option to on an individual basis, let an individual take it outside of that time frame. So if for some reason that time frame just does not work for you, let me know, and I'll reschedule it on an individualized basis. Okay? All right. So let's now, any other questions then before we jump into chapter 1? Okay. All right. And what, by the way, when I get the Dropboxes updated, I'll email you guys too. So you'll know. Okay, let's jump into the study guide and I will download that. And okay. Whoops. I don't know what I just clicked, but okay, let me exit full screen there. There we go. All right, there's our study guide. I tried to click enable editing. Well, now, there, finally. All right, so you guys can see that, but let me try to at least get you guys on here. And what I'll do is just try to, heck, every on one, something else happens. Okay, so chapter 1 is first of all, definition of finance. They didn't really define it in the book. I have my own definition of finance. I probably should have just typed it right in there. And let me go ahead, type it in now. And sorry that you guys, our video panel keeps disappearing, but that's all right. Okay, so finance, the definition of finance, I'm going to put it this way. And this is my own definition. Finance is a field that uses, whoops, that's one thing you'll discover, I'm a horrible typist, that uses accounting and economic information. There we go. To make decisions, to make monetary decisions.
Are you showing the study guide? Because I see you, not the study guide.
Oh, really?
Yeah.
Okay. I thought I was showing the study guide. Is everybody just seeing me?
Yes.
Oh.
Yeah.
Well, that's no good here. let me go back to. Okay. Now are you seeing the study guide at all?
No.
Yet.
No. Okay. Let me get back to why is that doing this? Okay, let me do this. No, that's not one here. There should be another. Okay, go on this. And let me go full screen for a minute, try to figure out what's going on here. Stepping out. Oh, down here, share screen. But I had done that already, so I don't know. Can you see it now?
Yep, see it now.
Yep.
Okay, thank you. And by the way, if that happens again, let me know, because I remember one time I must have spent 20 minutes going over something, and then finally somebody says, you know, we can't see what you're talking about. Oh, I said, you haven't been able to see it this whole time? And they go, no. I wish you'd have told me like 20 minutes ago when I started going over it. Okay, so everybody can see now the study guide, right?
Yes.
Okay, good, good. So that's my definition of finance right there. You might want to, I'll try to save that later, but you might want to screenshot it maybe, just so you've got it. But again, finance is a field that uses accounting and economic information to make monetary decisions. So, you know, most people really don't know what finance is, and everybody has an idea. Well, it has something to do with money. It has something to do with accounting. And what I would say is the biggest difference between accounting and finance is accountants put together the information. They communicate the information. The finance folks are the ones that use that information to make decisions. That's how I would differentiate finance from accounting, is that accounting is more putting together the information, communicating the information, like through the financial statements or other means, whereas with finance, we're actually then taking that information and using it to make some kind of decision, and again, some kind of monetary decision, a decision that affects money. I used to say business decisions, but actually, you know, there's a lot of stuff we do in this course that could be applied to personal decisions as well. Like for instance, you know, should I refinance my loan, or should I get I could get solar panels, let's say, for my roof, and it would save on my electric bill. You know, is that something I should do? And you know, that type of thing. So anyhow, that's you know, so it doesn't always have to be business decisions, but it's always going to be monetary decisions. So it's going to use accounting information, and then also economic information, because, you know, obviously you operate within a particular economic environment, and so a lot of the decisions that you make have to be made in you know, terms of that environment. You know, what kind of economic environment are we in? Where is the economy headed? Where are interest rates at? Where are interest rates at? I mean, that's something, for instance, if you're going to refinance a loan, by the way, now may not be a bad time to look at that. If you guys have a loan at 3 7/8 or 4%, anything like that on a 30-year, I saw a couple days ago, our average on 30-year fixed rate now is down to 3 1/4. Had been down about 3 1/8, but it's come up a little bit. And on 15-year, it's like 2 5/8, something like that, you know. So you know, if you're thinking about refinancing, now would be a good time to look into it. Anyhow, so yeah, you know, where interest rates at, where are they headed? If you're refinancing, if you think rates are going down further, obviously you'd want to wait. Now, I don't think that's going to happen. The only way, in my opinion, that happens is if the economy continues on a recovery and there's no second. The only way they go back down, I should say, is if there is a second wave of the virus and they have to shut the economy back. Let's hope and pray that that doesn't happen. You know, things are looking good on that front for the most part. I know some states have seen increases again, but most states haven't. And now that it's summer, hopefully it goes away, and maybe we'll luck out and it'll just go away for good. I know that's not something we can plan on, but it's not out of the realm of possibility, from what I've heard, that it could just disappear. I think they said that what happened with the SARS virus. They got hot, and all of a sudden the virus, they don't like warm weather. Anyhow, that's a little, this isn't biology or chemistry or whatever. This is finance. But the point is, yeah, if there's a second wave and all of a sudden the economy has to shut down again, you will see interest rates go back. If that does not happen, my suspicion is rates have already come up some and are probably going to continue to come. And again, you also have to look at the economy. Is the economy growing? Is it shrinking? Obviously, we have just come through a recession. They say the recession started, we peaked out in February, so that's when the recession would have started. It was the end of, I think the end of February is what they're saying now. It's probably already over. I mean, it was the deepest recession we've ever had, but probably the shortest recession we've already had. That doesn't mean the economy's back to normal, but what it means is the economy is growing again. So while it's certainly the economy, and it could take years before the economy is back to where it was before all of this, it's definitely growing again, you know. So that's when a recession ends, is when the economy starts growing again, not when the economy gets back to a previous peak. So not at a previous peak. But the fact that we had their last month, they discovered 2.5 million new jobs were created, which was unexpected. They thought it was going to be completely the opposite. Unemployment is now at 13.3%. The highest it got, by the way, during the financial crisis back in, well, the recession really hit. Crisis climaxed in '08 with the bankruptcy of Lehman Brothers. But, and we'll obviously be talking about the financial crisis here momentarily. But the recession really didn't hit full bore until '09. But the highest the unemployment rate hit in '09 was 10%. So we're now down to 13.3%, which, you know, I mean, while sounds kind of horrific, it's a lot better than what it could have been. So let's hope we're on this track. Anyhow, certainly if you were going to expand a business or something like that, you have to look at the economy and how that may impact your specific industry and your business. I know I was just reading today, and I think it was the Wall Street Journal, that you know, a lot of airports right now, for instance, had major expansion plans, and now they're rethinking those plans. You know, and well, we better wait and see if we're going to get enough passengers back to make it worth doing, et cetera. Okay, so that's our definition of finance. Next, we'll talk about the financial crisis. And I want to start with the causes of the financial crisis. Again, just as a bit of background, most of you probably at least have a vague recollection of when Lehman Brothers filed for bankruptcy. That was September, I think September 15th, if I'm not mistaken, of 2008. That was kind of the climax of the financial crisis. Up to that time, we were already in trouble before then. That is when all of a sudden things really kind of hit the fan. By the way, if we were face to face, there is a movie that I show all of my financial management courses. I also show it during my J-term course called Too Big to Fail. And it's a very factually based movie on the events of the financial crisis. And it looks at it for the most part from the point of view of Hank Paulson, who was the Treasury Secretary at the time. So he's kind of was the main character then, him and Ben Bernanke, who was the chairman of the Federal Reserve Board at the time. The New York Fed president, who later became Treasury Secretary, his name escapes me for the moment. Great movie, and I highly recommend it. But I thought, so I checked with the library. I said, because I've always gotten you know, a physical DVD from a library that I showed in class. They said, you know, because obviously I can't do it this time using the DVD version. Yes, I could have. I could have put a DVD, I don't know, put a DVD in here and shared the screen. Yeah, maybe. Anyhow, they said, yeah, they don't have a streaming license for it. But if you Google it, again, the movie's called Too Big to Fail. All-star cast of actors. I think you'll really find it interesting. And if you Google it, there's a lot of different sites you can download it on and stream it. Most of them, I think it's like, if you have to pay for it, it's like $2.99, like on YouTube, if you know, and stuff like that. For $3, you can have it. And it really helps to maybe fill in any gaps here or back up some of the things that we'll already be talking about here with regard to the financial crisis, but in a very, very human way, you know, as it was going, you know, takes place basically as things were happening. And like I said, it's an all-star cast, excellent movie. So what are the causes? Well, okay, mortgage loans being made to unqualified buyers. That was probably the biggest underlying cause, because we had kind of gotten to the point where, years ago, if a bank made a home loan to you, what did they do? 30-year loan, they'd loan you the money and they'd just collect your payments for the next 30 years, right? Well, that's not the way it works anymore these days. Now, banks will make the loan, and in a lot of cases, not all cases, but a lot of cases, they'll sell that to somebody else, the party. Now, what was happening is a lot of other banks, and particularly investment banks like Goldman Sachs, Morgan Stanley, JP Morgan, which actually is a commercial bank as well as investment bank. Banks like that would buy those loans and then they'd package them together, okay, and into mortgage-backed securities. In fact, I should probably sold as investments. I should probably add here called mortgage securities, or let's put an R in there. Like I told you, I'm a horrible type of mortgage-backed securities, or otherwise known as MBS. So they would sell, package these loans together and sell these as mortgage-backed securities. So again, why banks make loans to unqualified buyers? Well, they figured we don't have to worry about it. We're selling the loan anyhow. So what do we care if the buyer can't pay back the loan or not? Okay. Now, why would anybody purchase a loan, that was maybe sold to somebody with not stellar credit, maybe for more than they probably should have qualified for, and things like that? Well, again, they're like, worst case scenario, if they default on the loan, real estate prices are going up, right? And if real estate prices go up, and we can, and we have to foreclose, we'll be able to get our money back by selling the property. But then, of course, and plus the thing is, real estate loans historically had very low default rate. In fact, real estate loans, home loans had the lowest default rate of any type of loan there is, because people will, they may not make their other payments, they may not pay on their credit card or their medical bills or whatever, but people don't want to lose their house. So people generally make their mortgage payments. And so the assumption was, nobody defaults, hardly anybody ever defaults on a home loan, and real estate prices are going up. And so if they do default, we foreclose and we'll get our money back by selling it for a high enough price to get back what we're owed. Anyhow, no big deal, right? Well, of course, then what happens? Well, real estate was in a bubble. Real estate prices had been going up. So maybe I should put that too, real estate bubble. And then dash. And then, of course, like any bubble, sooner or later, it's going to pop, right? Sooner or later, things, I can't keep going one direction at too fast a rate. So, I remember back then, a lot of people were into flipping homes, people still flip homes to this day. But today, when people flip homes, usually they're, buying them, fixing them up a little and flipping them. But back then, people would buy something and, maybe fix it up a little bit, but not do a whole lot to it, just to hold it for a year or two, maybe even rent it out for a year or two as an investment property, and then turn around and sell it for a much higher price than they paid for because prices were going up that fast. In fact, I can tell you a personal story. My sister used to live in California, and she said to me, and I love California. I used to visit her a lot. My daughter lives out there now, and I remember my sister saying, "Why don't you move to California? You like California?" I'm like, "Yeah," but I said I can't afford to live out here in real estate. She said, "Oh, that's no problem. They'll make you a now." Okay, you've all heard of an interest-only loan, right? Where you just pay interest, and then at some point the principal comes due, like maybe 7 years down the road, whatever. Meanwhile, all you pay is interest. You don't pay any principal. They were making negative amortization loans, meaning you didn't even have to cover the interest with your payments. You could pay less than the interest owed and just let the balance on your loan just grow. And I said, well, how the hell does the bank expect to get paid back on that? She said, well, real estate prices out here go up so fast that when you can refinance or you can sell the house for a lot more than you paid for it, and they know they'll get their money. Well, again, that happens great as long as the prices are going up, but sooner or later you hit that bubble and you get a few, typically maybe some of the more sophisticated real estate investors realizing that, wow, things have come too far too fast, and this can't last, and they start selling at the top. And all of a sudden that selling pressure brings prices down, and then more people start selling, and that brings prices even lower. Well, of course, what happens then is, a lot of the loans then were getting defaulted on as prices were going down because people couldn't afford the loans. And they're like, why should I keep paying on a, say $400,000 loan for a house that now is only worth $300,000, So a lot of people were saying, hey, I'm just giving the bank the keys, I'm not going to pay this. Which, by the way, does hurt your credit if you do that. Anyhow, so yeah, a lot of the loans were getting defaulted on because housing values were going down. So that, of course, with the defaults, all of a sudden, even with a mortgage-backed security, you might have thousands of loans packaged into one mortgage-backed security. So of course, if a handful of loans get defaulted on, it's no problem. They'll still be able to pay out to the investor in those securities. But when enough, especially when the what's the term I'm looking for the loans that subprime, when the subprime loans, especially those were loans made to people who really didn't have good credit. Subprime means your credit score is like maybe, it's definitely below 600, maybe below 550, something. I don't remember exactly where the cutoff is. But yeah, so there were a lot of mortgage-backed securities made up primarily of subprime loans. Those subprime loans were getting defaulted on like crazy. And all of a sudden, even some of the mortgage-backed securities were in default. You think, well, how can it go in default? It would take 50% of the loans to be defaulted on before the security defaults. Well, in some cases with the subprime mortgages, that was actually happening. So, and all the banks and the investment banks, a lot of them owned a lot of those securities. A lot of them had accepted those securities as collateral, et cetera. So now you've got over leveraged investment banks like Lehman Brothers that got bankrupted. Lehman Brothers was the only investment bank, at least of any size, that actually went bankrupt, but many others could have, had it not been for action of the government. Bankrupted because they're like, well, they had a lot of leverage. They might have had, like, for instance, they said Lehman Brothers was leveraged like 30 to 1. So in other words, for every $30 of assets, they might have $1 in equity and the other $29 borrowed. Well, if you end up with a loss, if your equity is only 1/30th of your asset, and all of a sudden you have losses equaling 1/30th or just over 3 1/3% of your assets, you've got no equity left. You're bankrupt. And that's what happened. By the way, one thing too I wanted to mention is that, and I probably put that in as another, I'm going to make this actually letter F. I'm going to have to make sure this gets saved when I'm done. There's a difference between, you know, when a company has a liquidity crisis versus a solvency crisis. Okay. A liquidity crisis means, well, you just don't have enough cash and near cash assets to pay your short-term debts as they're coming due, but you are solvent. You do have a lot of assets that exceed the value of your liabilities. It's just that you don't have enough liquid assets. That's a liquidity crisis. Okay. The argument was made that Lehman Brothers not only had a liquidity crisis, they also had a solvency crisis. They had their liabilities exceeded the fair market value of their assets. That's basically why that was used as one of the excuses why Lehman Brothers was allowed to fail when so many others were bailed out. Anyhow, okay, so I guess I got to change this to letter G. Okay. So all of a sudden now, you know, Lehman Brothers freezes up and then, or goes bankrupt. And then people are like, well, who has exposure to Lehman Brothers? Who might, you know, who's owed money by Lehman Brothers? Because if Lehman Brothers can't pay their debts and somebody else is owed a bunch of money by Lehman Brothers and they got to take a loss on all that money they've loaned out to Lehman, they may go under too. And then who's exposed to that? You know, I mean, it's a chain reaction. It's a domino effect that, hey, yeah, you know, if Lehman goes, then anybody who had had loaned a lot of money to Lehman could be in trouble. And then anybody who loaned a lot of money to the bank that loaned Lehman could be in trouble, and so on and so forth. So it was a real fear of a domino effect. So all of a sudden the financial markets totally froze up. All the banks that had cash were hoarding it, not loaning it out because they weren't sure who had exposure to what. Everything was so kind of intertwined, you know, in the financial markets there. And so no money was being loaned out. Well, that's how the economy grows, is money goes from those who have it to those who need it to start a business, grow a business, you know, make payroll, buy a house on a personal level, et cetera, et cetera. No loans were getting made. And of course, because of that, we went into a severe recession. Not as severe as the one we just came out of, but longer lived than the one we just came out of. So I'm going to put severe recession. Ensues. Okay, let me change that from severe to severe. There we go. All right. Okay, and that's what happened. So how did the financial crisis get solved? Well, first of all, any questions on the causes? Okay. Now, what was the solution? Well, first of all, there was numerous rescues. In fact, before Lehman Brothers went bankrupt, about call it roughly 5-6 months prior to Lehman's bankruptcy, their Bear Stearns was an investment bank that almost went bankrupt. And the Fed and the Treasury, et cetera, they got JP Morgan involved, which was a good financially solvent bank run by a guy named Jamie Dimon, still runs JP Morgan to this day. Fantastic CEO. I own shares in JP Morgan stock, and part of the reason is because of Jamie Dimon. I mean, he's a rock star as far as bank CEO. Anyhow, Jamie Dimon, they ended up doing a deal to acquire Bear Stearns for like $2 a share. Well, then, it was trading, it closed on a Friday, I don't know, $3 a share, something like that, 20 some dollars a share. And over the weekend, they're like, they're not going to be able to pay their debts come Monday. And so JP Morgan says, okay, we'll buy them. We're going to pay $2 a share. And the Fed says, okay. And, Hank Paulson, the Treasury Secretary, Ben Bernanke, the Treasury or the head of the Federal Reserve, they said, yeah, okay, $2 a share. Well, shareholders that, saw the stock worth around $30 a share on Friday were not happy about JP Morgan being able to acquire it at $2 a share. They were afraid that shareholders would just say, hey, we're going to turn down the deal. Fine. We'll go bankrupt. We're not selling at $2 a share. It did later get raised to $10 a share. But anyhow, so that's one rescue of a bank. They had to rescue other banks. AIG. Here's the thing, just in a matter of days. And again, if you watch the movie, Too Big to Fail, all of this comes clear. But AIG, American International Group, which is a huge insurance company, they had been selling something called credit default swaps. In fact, I'm going to put that in there. Largest seller of credit default swap. Okay. And what's a credit default swap? Credit default swap says it's like an insurance policy. Remember, that was our first question in the CEPI homework. Says a credit default swap is most like what? It's most like an insurance policy. So basically, that was the other thing, is a lot of these investors and banks that owned a lot of these mortgage-backed securities, they would go ahead and buy credit default swaps saying, well, if by chance this security defaults, then our credit default swap will make us whole. And AIG was the largest seller of those credit default swaps. AIG is huge. The company is absolutely huge. And the fear was, all of a sudden, AIG didn't have enough money to pay its debts as they came to, and it didn't have enough money to pay off all its credit default swaps. And it's like, oh crap, what happens if AIG doesn't pay out these credit default swaps? How many other banks are going to fail because they thought they were insured because they bought credit default swaps from AIG, assuming AIG would stay solvent? If AIG goes under, they can't pay out those credit default swaps. A lot of those banks then go under, and then again, a lot of the creditors to those banks go under. And yeah, that was, they had to bail out AIG, but Dick Fuld, who was the CEO of Lehman Brothers, was super pissed that, hey, they let Lehman Brothers fail, and like 2 days later, they ended up taking a big stake in AIG to giving them, in like $80 billion, something like that, to keep them solvent and keep them having the ability to pay those credit defaults. thing I will say, by the way, in a way, we're kind of lucky we went through the financial crisis. You know how they say everything happens for a reason, right? Okay. I kind of believe that. Not always, but I kind of believe that. Well, you think about the recession and everything going on right now from this coronavirus. You know what? A lot of the actions that have been taken by the Treasury and the Federal Reserve came right out of the playbook from the financial crisis, right out of the playbook. Oh, Federal Reserve, we'll just print up a bunch of money and put it into the financial markets just to maintain liquidity. The Treasury, yeah, we'll come up with some kind of stimulus, et cetera. So also there were at that time several Federal Reserve programs and Treasury programs to keep liquidity in the markets. The Fed lowered interest rates and began quantitative easing. What's quantitative easing? It's basically the same thing they're doing now, printing up money. Okay, of course now they don't print it; they just make a computer entry and say, okay, we have a bunch of money now, and we can spend it by, for instance, buying treasury issues or other mortgage-backed securities, et cetera. This time around, they're not only buying treasuries and mortgage-backed securities, they're buying, even junk bonds, junk bond ETFs, things like that. So issued by corporations. So they're even going further than they did last time. Of course, last time when they announced that, everybody was scared to death. They're like, the Fed is going to print all this money. All of a sudden, their balance sheet went from just roughly $1 trillion to over $4 trillion after a year or two. And people were like, oh man, inflation is going to just run rampant with the Fed printing up all this money. And the fact is, it didn't happen. We know it didn't happen. So I think if they were gun shy about printing up a bunch of money to help solve economic crisis the first time around, the fact that they did it and it did not result in massive inflation afterwards has given them a lot more, forgive my language, but it's given them the balls to do it this time on an even bigger basis than they did during the financial crisis. Okay, so they did the quantitative easing, they lowered interest rates, money funds, money market funds had to be backed because all of a sudden there was a money market fund that owned some what's called commercial paper, which is, put it this way, if a corporation or bank wants to borrow money on a long-term basis, what do they issue? They issue bonds. If they want to borrow money on a short-term basis, they issue commercial paper, okay? So Lehman Brothers had issued a lot of commercial paper. Well, one of the money market funds all of a sudden was having to record a loss because of the commercial paper issued by that they owned, issued by Lehman Brothers. And it's like, everybody always thought money market funds were a super safe place to invest your money. And now all of a sudden, if they're losing money, now there's going to be a run on the money market funds. Well, they're a big buyer of commercial paper. And that's how, again, a lot of companies, banks and other big companies finance their operations. That's how they make payroll. That's how they buy inventory, et cetera, is by borrowing money, by issuing commercial paper. And it's like, well, if there's a run on the money market funds, then who's going to be left to buy the commercial paper? So the Treasury had to say, okay, if you have money in a money market fund for, I think they used a period of 2 years, if I'm not mistaken, that nobody's going to take a loss in this money market. Okay. And they had various programs to try to stimulate the purchase of commercial paper, keep credit flowing, to try to keep the recession from getting any worse than it was, and keep the economy from really going into a deep depression. And then we had TARP. I can't believe I didn't put TARP. ARP. Okay, toxic asset relief program. Actually, maybe the word toxic was a lot of times used. Technically, it ended up being termed the troubled. So let me change that. Troubled asset relief program, TARP. That's when, and that's a big part of the movie too, when Ben Bernanke and Hank Paulson went to Congress and they said, hey, we need money, because the Fed said we can't keep printing up money. It's to bail everybody out. Treasury has to have a part of this too, because the Federal Reserve, they don't get elected. They get nominated. Federal Reserve President like Ben Bernanke, they get nominated by the president and confirmed by the Senate. Okay, they do not. They're not elected officials. Treasury is also appointed by the president, but at least you can say, well, Fed acts independent of the president, even though under our current president, he has tried to tell the Fed what to do several times, and they've done the right thing in spite of what he's tried to get them. But anyhow, yeah, it's so the idea was we have to have some of this has to be financed by Treasury, which was under President Bush at the time, and they're like, we got to get Congress to approve money for us to help rescue some of these firms and save the economy. And so, and you'll see in the movie, they kind of pulled a number out of the air. They said, it's got to be a big number. And they go, like $1 trillion? Congress is never going to go for $1 trillion. They threw some numbers out and they go, how about 700 billion? They go, well, better than $1 trillion. So they go to Congress and say, we need $700 billion to help bail out some of these firms to keep the economy going. And of course, it was not popular with Congress. And the first time the House voted on it the first time, and they voted it down. And then there were a few little amendments made, and then it went through the Senate the next time around, like a week later, and it get passed. But it had to get passed. I mean, people thought of it as, well, this is a bailout of these big Wall Street banks. It was a bailout of the entire economy. Because if those banks go under, then you know how many other businesses go under. And if those businesses go under, how many other businesses go under, and how bad all of a sudden the economy gets, and how high unemployment is, et cetera, et cetera, et cetera. They had to bail. They really didn't have a choice because the economy would have been so much. And by the way, not all banks were bad actors here. It's like anything. There's, everybody blames all of Wall Street for a few bad actors like Lehman Brothers, that were over leveraged, that, some of the banks that were making these subprime loans, et cetera, they all get lumped together, but they shouldn't. Okay, so anyhow, that was after TARP, they were able to kind of stave off the rest of the financial crisis with various rescues. By the way, one of the rescues, they weren't all banks. Again, AIG was an insurance company, and General Motors was also, that was TARP money that bailed out General Motors. It kept them from going bankrupt. Chrysler as well. Okay. So now we know, all right, what caused the financial crisis. And of course, because no money was being lent, we go into this severe recession. Here's how it gets solved. Meanwhile, of course, Congress is like, we got to make sure this doesn't happen again. How do we make sure this doesn't happen again? So they passed, the official name is something else. It's in chapter 1 of your book, but it's unofficially called, known as the Dodd-Frank Act. Named after Senator Dodd and Congressman Barney Frank. It was created in response to the financial crisis, And one of the things, because Dodd and Frank were Democrats, they said, first of all, some of those people who got into those in over their heads on these loans probably didn't know better. You know, a lot of them were lower income, unsophisticated borrowers. They didn't understand that maybe, for instance, a lot of these loans had teaser rates. You paid like a real low rate for like 2 years, and then all of a sudden the rate jumped. And of course, when the rate jumped, the payments jumped. Well, you know, I'm sure some consumers understood that, and some banks explained that to their consumers before they made the loans or signed for the loans. But probably not everybody understood. Probably not all banks were clear at making sure that that they did understand it. So they said, we got to protect the consumer. This was Republicans are like, oh, we just got to get make sure get the economy back on track, et cetera, et cetera. Hey, it's not the consumer, that we got to protect. Those people should have known better. They should have known they couldn't afford those loans. Well, again, maybe, and I'm sure there were cases where that may have been true, but in other cases, they may have been told, hey, don't worry, the price of your house is going to go up. We'll be able to refinance this when the higher rate kicks in. You'll be fine. Oh, okay. Or again, they just didn't realize the rate was going to go up, et cetera. Or maybe they thought, well, I must be able to afford it because why would the bank loan it to me otherwise? Right? They're smart guys. They shouldn't be loaning money that they're not going to get back. So if they tell me I can afford it, I must be able to afford it, right? Okay. So that was one of the parts of it. It created the Consumer Financial Protection Bureau, which, by the way, under Trump has no teeth left in it whatsoever, because he put somebody in charge of it who basically asked for no money to be allocated to their budget and everything. It's kind of it had teeth until Trump became president. It has no teeth. Okay, next. Increase the oversight of derivative securities by requiring more of them, like derivative securities, like, for example, credit default swaps, are to be cleared through formal exchanges or clearinghouses. That way, you don't have to worry about counterparty risk. See, the fear with it, the reason they had to bail out AIG, all these companies had, and by the way, I'm going to go ahead and scroll a bit so I can read. Everybody seems to be paying pretty good attention. The ones I can see of you. So I'll scroll down, see the rest, and try to get a read on the room, as they say. Okay, so the credit default swaps, that would be sold by AIG to like banks or other investors in these mortgage-backed securities. And it's like, well, if AIG can't pay them, then they just get defaulted on. Well, okay, so if we require them to be cleared through a formal exchange or clearinghouse, here's the difference. Then the exchange would act as the buyer for all sellers and as the seller for all buyers. So they could make sure there was plenty of collateral and things like that from the buyers and sellers to make sure the money would be there for the credit default swaps to pay off in the event of a payoff type event. Also, Dodd-Frank increased capital requirements on banks. When we talk capital on banks, what we're saying is equity. You remember, the balance sheet says assets equal liabilities, which is debts owed by the business or bank in the case of a bank, plus equity. Okay? So when they increase capital requirements on banks, that means they increase the equity requirements. Also required banks to pass stress tests saying, okay, if the economy gets really bad, can the bank still, be able to stay solvent? Finally, one of the more, and this isn't comprehensive, of course, one of the more controversial parts of it was the Volcker Rule, which says we're going to limit proprietary trading by banks for derivatives or private equity investments, saying, hey, banks should not be taking a risk like they were taking on some of these investments. And so we're going to not let them invest in derivatives or private equity investments, you know, things that aren't publicly traded, et cetera. We don't want them taking those risks. But the banks would turn around and argue, like JP Morgan. They're like, well, hey, yeah, but we're market makers in those securities. We can't be market makers if we can't maintain an inventory of those securities. Or in some cases, again, a bank would buy credit default swaps to hedge. Now, not every time that credit default swaps were bought were they bought for hedging, but most of the time they were. And banks are like, hey, we need to hedge our investment in mortgage-backed securities by buying credit. They're like, okay, you can still do it for hedging and market making activities, but that's it. So that one took a long time to write. Frank. All right, I have been yakking away here for an hour and a half already. We got about a half hour left. So we have now gone through our definition of finance. We've gone through the causes of the financial crisis, the ensuing recession, the solutions to the financial crisis, and the Dodd-Frank Act. By the way, I'm just going to click Save As here just to make sure I do get that saved. And whoops, I'm going to have to move us a bit here to do that. Save, there we go. All right. Yes, we're replacing. All right. So anyhow, any questions at this point? So let me kind of scroll through our folks here. Anybody? Oh, no questions at this point? All right. Hey, man, and like I say, if we don't get through chapter 2 tonight, that's okay. All right. If in fact, we may not even get started on chapter 2. That's okay if we don't. Right. Okay. That's it then on the financial crisis. So that was a huge part of chapter 1. Obviously, there'll be test questions about the financial crisis, primarily multiple choice questions. Okay. They also in chapter 1 talk about forms of business organization, like sole proprietorship. In fact, I probably should have put that before. Oops, I don't want that. I want a here. Sole proprietorship. Is that right? Hey, I did. All right. Sole proprietorship. That's a one-owner business. Now, can the owner of a sole proprietorship be held personally liable for the debts of the business? In other words, is their liability limited or unlimited? Limited means it's unlimited, exactly. Unlimited means not only could they lose their entire investment, on top of that, they could lose their house, their boat, their car, their everything in their personal savings account, etc. So they have unlimited liability, and they also are taxed. Well, let me put it this way. Is there a separate income tax on the business?
No.
No.
No. So I'm going to put that for the liability. Then I'm going to put personal income taxes only. In other words, there's not a separate income tax on the business. As a sole proprietor, you will file as part of your tax return, you'll file what's called a Schedule C. It's possible that some of you in here have filed, or in this class, have filed a Schedule C before as part of your tax return. And a Schedule C just basically says, here's what my business income was. That gets combined with any other personal income you have, like from a salary and things like that, on your personal income tax return, and you pay personal income taxes only. So there's not, the business income is taxed, but it's taxed at your personal level. That's why sole proprietorships and partnerships, a lot of times, as well as S corporations, are called pass-through entities, because the income passes right through the business to the owner of the business for tax purposes. Maybe I'll put that in here, pass-through entity. Okay. And okay, so next we'll talk about partnerships. Now, partnerships can have general partners. There is such a thing as a limited partnership that you could also have limited partners. But as far as general partners go, this is important. A general partner can be held personally liable for 100% of the partnership. So, you know, let's say Ishmael and Laura and Kelly, you three are three equal partners in a business. And you're all equal partners, supposed to share profits and losses equally. But let's say the business goes broke. Okay, and the assets of the business are not sufficient to satisfy the debts of the creditors. So the creditors can then go after the personal assets of each of you. Yeah. Let's say Kelly doesn't have any personal assets left for the creditors to acquire, and neither does Laura. But Ishmael, he's independently wealthy. He's got a bunch of assets that they could take in order to collect their debts. Guess what? He's going to be held personally liable for 100% of the remaining debts. And I bring that up because it does happen. It happened to my dad years ago in a business he was in. He was in the motel business. He owned Super 8s and a couple other brands of motel. But he decided once to go into the restaurant. And he started brand new from scratch, him and two other business partners, a Bonanza restaurant. Well, these two guys were friends of his, right? They built this Bonanza restaurant, small town in South Dakota. That's back in like the early 80s. And it turned out that the business was losing money. They finally shut the doors on the business. But the time they shut the doors on the business, they still owed like a $600,000 loan to the bank. Okay. Well, so either the bank was going to take the building, or one of them had to keep making payments on a loan. So guess who had to pay off that whole thing? Because one of his partners filed personal bankruptcy. The bankruptcy court said, okay, you're bankrupt. You can't pay on that business loan. The other partner said, hey, if I want to file bankruptcy, but if I'm forced to pay on this business loan, I'm going to have to file personal bankruptcy. So my dad ended up having to pay the whole thing, the entire $600,000 loan himself, because he was, he was a partner that still had the ability to pay that loan, and so he got stuck paying the whole thing. So again, you can be held 100%. I guess I better make this. You can be held personally liable for 100% of partner general partner. Now, we'll put a semicolon there and say limited partners have limited liability. Now, by limited liability, it doesn't mean you can't lose money. You can still lose your entire investment. It just means you can't lose more than your investment. In other words, if the business goes broke, yeah, whatever you put into the business, you may lose it, but you're not going to lose your other personal assets. Creditors cannot go after your personal house, boat, car, savings account, all those kinds of things, if you are a limited partner. And then And again, these are pass-through entities for taxes. What happened there? I hit semicolon. I go pass through entity. All partnerships are pass-through entities, meaning that each partner just pays personal income taxes on his or her share of the partnership income. There's not a separate tax on the business itself. Okay. Next, we have corporations. And so first we'll talk about S corporations. S corporations are taxed basically like partnerships. In other words, they are pass-through entities. Entities, there we go. Where there's not a separate tax on the business itself, a separate income tax, at least on the business itself. Each individual just pays personal income taxes on his or her share of the business income, just like with a partnership. Okay. Now, because it's a corporation, the owners have limited liability. Just like, you know, if well, for instance, I told you before, I own some stock in JP Morgan. Okay. If JP Morgan couldn't pay their debts as they came due, could the creditors of JP Morgan say, oh, hey, Rob, you're a shareholder in JP Morgan. They can't pay their debts, so you're going to have to sell everything you have to help pay those debts. Could they do that? The answer is no. As a shareholder in a corporation, you have limited liability. And of course, not all corporations are JP Morgan's or Apple or Amazon or Microsoft or, you know, any other big company. Small businesses are also incorporated. So if you're a small business that's incorporated and you go to the bank and you say, okay, I want to borrow money in the name of my corporation, the bank is likely to say, if they're willing to loan the money, they'll say, yeah, we're willing to loan you the money, but we want you to personally do what? What do you think?
Guarantee.
Guarantee it. Exactly. They'll expect a personal guarantee. So they'll say, okay, we'll make a loan to your corporation, but we want a personal guarantee saying, if the corporation can't pay back the loan, then you personally will pay back the loan. Just like, you know, so you need to sign a guarantee or be a co-signer, just like, you know, when my kid, my oldest son was in college and I co-signed his car loan, and then of course the little shit didn't pay it when he was supposed to. So I was stuck. Right? He still to this day likes to imitate me about, boy, you're ruining my credit. I would call him up so angry, like, because he wasn't making his payments. So I'd either have to make the payments or get him to make them. And it was like every month I was getting late notices on his car payment because he wasn't making the payments. Anyhow, yeah, same kind of deal. So if the corporation can't pay, then the owner would have to. So I'm going to say owners have limited liability, and I'm going to go except for any debts personally guarantee.
So I thought that businesses.
Kelly, is that you talking?
Me, sorry.
Yeah.
I thought businesses that had shareholders, I mean, had to pay out to shareholders first.
Oh no, shareholders are last to get money. The shareholders are last in line. You got to pay all they got to pay all the creditors before shareholders. So if a corporation were to go broke, the last ones, if there's anything left after they've paid all the creditors, all the bondholders, et cetera, and that includes also any then preferred stockholders, the common stockholders would be the last in line to get paid.
But still before the corporation, right? I mean, they don't get to keep anything. I mean, they're last, right? Like
Well, yeah. I mean, the corporation is kind of
made up.
it's a paper entity,
Yeah.
right? And it's a paper entity. It's a real business, but the corporation itself is a name. You know that there's actual creditors to that corporation and there's owners of that corporation. So, yeah, I mean, no, there's not like some kind of special entity that gets to keep any money separate from the creditors. Now, not all corporations are S corps. Why? Well, number one, you can't have more than 100 shareholders and be an S corp. In that case, then you're a C corp. And as far as C corporations go, there is a separate income tax. So maybe I'll put it this way: separate income tax on the business. And because of that, we then have what we call, I don't know why, capital some things and not others here. I'll clean that up a little bit. All right. Separate income tax on the business. You have double taxation on C corporations because the corporation pays income taxes on the money it makes, and then any of that money that is then distributed to shareholders in the form of dividends, shareholders have to pay personal income taxes on. So the same dollar of income actually gets taxed at two different levels. Okay. Now, for that reason, I was having a discussion. I'll just be upfront and honest with you guys right now. I'm not a Trump fan. Okay. Okay. But and I was having a discussion with one of my minority friends, very good friend of mine, and I said, that doesn't mean I think everything he ever has done is bad. He goes, name one good thing he's done. I said, well, I do believe lowering the tax on corporations is a good thing. Why? Because number one, there's the double taxation to begin with, and number two, we being the U.S. The U.S. had the highest corporate tax rate in the world at 35% before it got lowered by Congress and signed by Trump to 21%. So now personally, I probably would have been more in favor of how about cutting it from 35% to 25% rather than 21%. But you know, that's splitting hairs, I guess, at that point. But I did believe corporate tax rates should have been lowered because, again, number one, we had the highest corporate tax rates in the world. And number two, you have double taxation with corporations. And for those two reasons, I thought, yes, we should lower the corporate rate. Again, I probably would have thought 25% would have been a good one, but they went it was Congress that actually chose to go all the way down to 1%. Yeah. So that's C corporations. As far as the liability for owners of C corporations, it's limited, just like except for any death personally guaranteed. Typically with a C corp, well, no, I can't say that. I just sold a motel in the last year for my mother that was actually run as a C corporation, and so there would have been when there was debt owed on it, there definitely would have been a personal guarantee on it. Okay, and then most small businesses these days are organized as LLC, limited liability company. Okay, and which means, of course, again, they have limited liability, except for those deaths personally guaranteed, like, you know, in any case. And also, as far as taxes go, they get to choose their tax status. So they can choose whether they want to be a tax like a partnership or an S corporation or a C corporation. Now, one question I get asked is, well, can they switch from one year to the next depending on which one is most beneficial? And the answer to that is no, they can't do that. It's not that you can never make a switch, but if you're going to make a switch, you have to have a good reason for it. And you have to get IRS permission. And there would likely be back taxes paid as well in the case of a switch. So, but you might say, well, actually, for my business, it might be better to be taxed like an S corp or a corporation, or maybe because of the 21% tax rate, I think you're going to find a lot more small businesses choosing to be taxed like C corporations, take advantage of that 21% corporate tax rate. Now you might say, yeah, but what about the whole double taxation? Well, if you own your own business, you don't do the double taxation thing. Why not? You don't pay yourself a dividend. If I own my own business, I'm the CEO of that business, right? What does every CEO get? A salary, right? I'm going to get a salary as the CEO of the business. And yes, I'll have to pay personal income taxes on the salary I draw from the business, but the rest of the income I leave in the business would get taxed at that lower C corporate. Anyhow, so there may be even a good reason to be a C corp, even with the double taxation, as a small business. I think that's close to our 2 hours. I think if it's okay with you guys, I feel like we have covered enough for tonight. I just want to see if there's questions. So does anybody have any questions about any of the things that we covered?
I don't have a question, but that movie is on HBO free if anybody has HBO. Otherwise, you can rent it for like $2.99 on a couple places.
Yes, yeah, that's right. It is. If you have HBO, it is free on HBO. Yep. Yeah. So yeah, and I don't know. You could even check like Amazon Prime. I don't know if they have it. And even on Prime, sometimes you have to pay for stuff. Because I got Prime, but
I think it was $2.99 on Prime.
$2.99 on Prime. Yeah, yeah. I don't know if Netflix has it. I don't think they do. Yeah, Too Big to Fail. Great movie. Great movie. And again, it really explains everything we went through on the financial crisis, but it does it in a probably a more exciting way than just listening to me talk about it. Any other questions? So if you're wondering, well, is there anything you should do before next week? I would say just make sure you've read chapters 2 and 3, and 1, chapters 1, 2, and 3. Do you need to have any of the acceptee homework started? Yeah, you could start maybe the first few questions, but that's about as far as you could get them, assuming you want to wait until we've covered it in class before you. So yeah, just make sure you have the first 3 chapters read. I'll pick up with this. Remind me where we left off, which again is on Sarbanes-Oxley right here. And then and we have just that and the whole maximizing shareholders' wealth and social responsibility of corporations coming up for chapter 1, and then we'll get right into chapters 2 and 3 after that. So any other questions? Where was my arrow? Oh, there it is.
Is there a limited number of times you can get into those assignments?
No, once you're once you're registered for it, you should be able to get in anytime. I think automatically saves your entries too. So in other words, yeah, you don't have to do all of assignment 1 and accept it one time. It could work for, half hour, an hour, and then stop, and I'm pretty sure it automatically. And then when you go back in, you just have an option to pick up where you left off. Okay, good question.
Yeah. On the Zoom meeting invite, this class meets 10 times, correct?
Yes.
Yeah. The Zoom meeting invite, I downloaded it to my calendar. It only shows 7 meetings through July 20th, but you're going all the way through, I believe, the second week of August. Is that right?
Yes. Yeah. And that might be because of, I may just have to go in and edit that. The other possibility is I'm actually right now paying for my own Zoom account to be able to do this, but Mount Mercy has finally, as they should have from the beginning, is finally kicking in to pay for the Zoom meeting. So it might just be that maybe my subscription expires July 20th. Either that or else I just didn't put it in for long enough. I'll check on that, Tom. Thanks for letting me know. Either way, I know by that time for sure my subscription expire, and then I'll be using the college Zoom subscription instead of my own. Okay, Zoom meetings through August. Okay. Anything else? All right, well, we'll pick up where we left off. And next time, you guys have a great week. It was nice getting to know you all a little bit here this first night, and I'll get to know you better each and every week. And sometimes it is going to be a lot of me talking, but when I can, I'll try to get you guys to interject here and there. But financial management is just not one of those courses that's really conducive to like class discussion, So when I can, I'll try to get a little discussion going. But a lot of the times it will be maybe listening to me, and that's 2 hours of that's enough for anybody, right? Okay. Any other questions, comments? All right. Have a great week, everybody. I'll see you next week.
Thank you.
You bet. Thank you.
All right.